Hello, everyone. Welcome to this video where I'm going to talk about Jarvis Securities. And as you can see, the name of this video is We Invested in Jarvis Securities, then it fell 50%. So, with that being said, let's talk a little bit about the background of this investment. We invested in Jarvis in October in 2023 at £1. And as I just mentioned, right after we invested, the share price fell around 50%. So here you can see in the chart, we invested on the 23rd of October at 100 pence, so £1, and then immediately after, it basically fell 50% to 50 pence. Now, our investment system dictates that we invest more money when an investment falls 33%, but this time we didn't follow that rule. Now, why is that? Well, that is what I'm going to talk about in this video. But before I do that, let's start off with what Jarvis Security does. Jarvis Securities offers stockbroking services to retail and institutional investors. And to keep it very simple, we just asked ChatGPT to summarize what they do. And here are some examples of what they do, although this is not an exhaustive list. So they do stockbroking services. They buy and sell securities on behalf of clients. Then they do custody services, where they hold client assets in safe custody. They also do settlement services, where they handle the settlement of trades, ensuring that transactions are completed accurately and in a timely manner. And they also do corporate actions, which is that they manage corporate actions on behalf of clients, such as dividend payments, rights issues, stock splits, and mergers. And the last thing here, though, we'll mention is online trading platforms. So they offer online trading platforms that provide clients with access to markets and the ability to execute trades electronically. So moving on to why we invested in Jarvis, it's actually pretty simple. We looked at Jarvis and we saw a company that was growing in a very consistent manner and that actually had very good financial ratios. So let's start by looking at the revenue chart going back about 20 years. We can see that revenues grew very consistently over that time period. And over the last 10 years, the compound annual growth rate was 7.5%. So that wasn't, that's not an incredible number, but still a decent number. And it's very consistent, which we like to see. And then in 2022, the last full year that we had available when we invested, the revenues had dipped a little, but we didn't feel that that was a big worry. It was a difficult macroeconomic environment, and sometimes companies' revenues drop. Like you can't expect it to just go up forever, so it didn't worry us too much. And then moving on to net income, it had grown in a nice and consistent manner as well. It had also dropped a bit in 2022, similar to the revenues. However, the company had seen 3 years of declining net income from 2007 to 2010 and recovered nicely from it. So we were prepared for a few years of declining net income. And the net income margin had always been very good. I mean, the lowest it went was 12% in 2005, which is very good. And during the period from 2007 to 2010, where net income was declining, the net income margin was actually, in the 20s and 30s. And most recently, it was as high as like the 30s and 40s, as you can see from there. So this is a very good net income margin for a company. And then we move on to return on equity. And that has historically been very high as well. The lowest it ever went was also in 2005 at 22%. That's very good. And in 2022, it was around 100. And these are very good numbers. So although Jarvis wasn't the highest growing company, and despite seeing net income decline from 2007 to 2010, and again in 2022, we felt that the ratios were so good and the revenue growth so consistent that it was worth investing, especially at the low valuation that we could get it at. So that being said, we're moving on to our investment. So we invested 5% of our portfolio in Jarvis in October 2023 at £1, as I mentioned earlier. We estimated that the fair value was somewhere between £1.36 and £2.08 per share. So we therefore felt that a price of £1 was very reasonable. Now, what happened after we invested? So you already know kind of what happened. It dropped 50% almost immediately, as mentioned earlier. But why did it do that? Well, firstly, Jarvis had been paying a quarterly dividend every quarter since 2010. But then in November 2023, the company declared that it would not pay a fourth quarter dividend that year. They also had increased their dividend every year from 2010 until 2020. But in 2021, 2022, and so far in 2023, the dividends had decreased from the year before. And then secondly, the Financial Conduct Authority in the UK, the FCA, had in September 2022 requested Jarvis to conduct a review of their business. And the company also agreed to voluntary restrictions on certain parts of their business. So the company did not provide great detail on the matter, which we didn't particularly like. But it seems like the aim was to be more conservative with the types of client they took on board. So in other words, they wanted to reduce the risks that they had clients that were engaging in criminal activities, basically. And we did not get the feeling that they had been accused of wrongdoing by the FCA, but rather that their risk management was not stringent enough. And the review was supposed to take 6 months, but in November 2023, 14 months after it was announced, they announced that they needed to undertake an additional review. They did not provide information on why this had to be done, just that it had to be done. So naturally, the market reacted negatively to the news about the dividend and the extension of the review, and the share price fell around 50%. Now, with all this said, what are we doing now? As I mentioned earlier, according to our investing system, we invest another 2.5% of our portfolio when the share price of a stock falls 33%. Now, we did not do that with Jarvis. And the reason was because we don't just blindly invest more in a stock when the price falls. We do a quick review to determine if the core business has changed. And with Jarvis, we weren't sure if this had happened. They haven't provided enough information about the FCA review, so we are not able to determine if their core business has been altered in any way. If it has, then our valuation calculations will be incorrect, and we can't determine the fair value of the company. This was a new situation for us, so we weren't sure what to do. We considered buying more shares, but we felt we didn't have enough information to make that decision. We also considered selling the shares, but again, we didn't have enough information, and we had already taken a 50% loss. And the shares were incredibly cheap at the moment, so we felt there was a chance that the shares were undervalued and would recover. We therefore decided to do nothing because when none of the two paths were clear, we thought it would be best to just do nothing and wait. And we are also interested in seeing what ends up happening. So we want to hold on to our shares. We are sort of treating this as a little bit of an experiment, because I feel like often you have to do that with investing. You can never know for sure what's going to happen. And if you hold shares, then you are invested in what happens in the future, and you will remember what happened later. And this can be a good learning lesson. Like in hindsight, a decade from now, should we have sold the shares, or should we have bought more, or should we just have held? Like this can be a good learning opportunity. And with that being said, thanks again for watching, and see you on the next one. Bye.